Crypto terms explained, everything you need to know. If you've ever tried to get into crypto and felt overwhelmed by the jargon, you're not alone. From blockchain to staking, DeFi to hash rate, crypto comes with a vocabulary all its own, and it can feel like a completely different language. For newcomers, this wall of unfamiliar terms is often the biggest barrier to understanding how the space works, let alone investing in it. That's why this deep dive exists. We're cutting through the noise and giving you clear, simple explanations for the most important terms in crypto today. Before we begin, an important message: crypto assets are high risk and not regulated in the UK. You could lose all the money you invest. There is no consumer protection. This content is not financial advice. Always do your own research. The good news is that once you understand the foundational terms, everything else starts to make sense. Terms like layer 1, wallet, smart contract, and gas fee aren't just random phrases, they describe how blockchain works, how people use it, and how value is transferred across digital networks. Learning them is like learning the map of a new city. At first, everything feels disjointed. But soon, you start seeing how the roads connect. And that's when confidence kicks in. This deep dive is structured to build your understanding progressively. We'll begin with the basics, like what a blockchain is and how crypto differs from traditional finance, before moving into more complex ideas like consensus mechanisms, tokenomics, and zero-knowledge proofs. Along the way, you'll encounter the terms used by investors, developers, and everyday users, all explained clearly and without technical overload. By the end, you'll not only know what these terms mean, you'll know how to use them in real-world crypto conversations. Let's start with the most foundational term in all of crypto: blockchain. At its core, a blockchain is a digital ledger, a record of transactions stored across a network of computers. What makes it unique is that it's decentralized, meaning no single party controls it. Instead, everyone in the network works together to verify and record data. Each block contains a bundle of transactions, and blocks are linked together chronologically to form a chain. That's why it's called a blockchain. It's literally a chain of blocks. Closely tied to blockchain is the concept of a cryptocurrency. A cryptocurrency is a digital asset built on blockchain technology. It uses cryptographic techniques to secure transactions, control new issuance, and ensure trust without a central authority. Bitcoin was the first cryptocurrency, and it remains the most well-known. But today, there are thousands of other cryptos, like Ethereum, Solana, and Avalanche, each with different use cases, designs, and communities. Cryptocurrencies can function as digital money, access tokens, governance tools, or even representations of real-world assets. A term you'll hear often in crypto is wallet. A crypto wallet doesn't store your coins directly, instead, it stores your private keys, which give you access to your digital assets on the blockchain. There are two main types: hot wallets, connected to the internet, like MetaMask or Trust Wallet, and cold wallets, offline and more secure, like Ledger or Trezor. Your wallet is your identity in the crypto world. When you send or receive coins, it happens via wallet addresses, long strings of letters and numbers tied to your keys. One of the most common terms you'll hear is gas fees, especially if you're using Ethereum. Gas is the fee you pay to process transactions or run operations on a blockchain. It's like paying a toll to use the network. The more complex the action, like executing a smart contract, the higher the gas fee. Fees also fluctuate based on how busy the network is. On Layer 2 chains like Arbitrum or Optimism, gas fees are much lower because they're designed to scale Ethereum's traffic more efficiently. Speaking of smart contracts, these are self-executing programs that run on the blockchain. They automatically carry out actions once certain conditions are met, without needing a third party. For example, you can create a smart contract that holds funds and only releases them when two people agree. Smart contracts are the building blocks of decentralized applications, DApps, which power everything from lending platforms to NFT marketplaces. They make crypto programmable and eliminate the need for middlemen. Another term you'll often encounter is DeFi, short for decentralized finance. This refers to financial tools built on blockchains that don't rely on banks or brokers. With DeFi, you can lend, borrow, swap, and earn interest, all without a traditional financial institution. Platforms like Uniswap, Aave, and Curve are some of the most popular DeFi protocols. They use smart contracts to provide services that would normally require a whole company in the traditional world. When diving deeper into DeFi, you'll come across the concept of liquidity pools. These are pools of tokens locked in smart contracts that allow users to trade assets or earn passive income. Instead of relying on a traditional order book like in a stock exchange, DeFi protocols like Uniswap use these pools to facilitate trades. Users who supply tokens to these pools are called liquidity providers, and they earn a share of the trading fees in return. This is one way DeFi replaces central intermediaries with automated systems. You'll also hear a lot about staking, especially in the context of proof-of-stake, POS, blockchains like Ethereum, post-merge, Cardano, or Solana. Staking means locking up your crypto assets to help secure the network and validate transactions. In return, you earn rewards, often in the form of more of the same token. Staking is the POS equivalent of mining in proof-of-work, POW, systems like Bitcoin. It's how blockchains incentivize participation and security without requiring massive energy consumption. Another essential term is tokenomics, which refers to the economic design of a cryptocurrency. This includes how the token is distributed, how many will ever exist, its supply, whether it has inflationary or deflationary mechanics, how rewards are structured, and what the token is used for. Strong tokenomics can drive demand, increase adoption, and sustain long-term value. Weak tokenomics often lead to pump-and-dump schemes or declining prices after launch. Understanding the economics behind a token is critical for any serious investor. Another critical concept is the block reward, the incentive given to miners or validators for securing the network and adding new blocks to the chain. In proof-of-work systems like Bitcoin, miners compete to solve complex mathematical problems, and the first to solve it earns the reward. This reward includes both the newly minted coins and any transaction fees from the block. In proof-of-stake systems, the reward goes to those who stake their tokens and are chosen to validate blocks based on criteria like stake size and time. Let's now clarify what mining actually means. In crypto, mining is the process of validating and recording transactions on a blockchain, usually through solving cryptographic puzzles. In Bitcoin, this is done using high-powered computers, making mining energy intensive. However, it's crucial for maintaining security in proof-of-work blockchains. Some networks have moved away from mining due to its energy demands, shifting toward proof-of-stake models where energy use is minimal, and security is maintained by staking tokens instead. One term you'll definitely hear in crypto circles is NFT, short for non-fungible token. An NFT represents ownership of a unique item, typically digital art, music, collectibles, or game assets. Unlike cryptocurrencies like Bitcoin, which are fungible, one BTC is the same as another, NFTs are one of a kind. They're stored on blockchains like Ethereum or Solana, and their ownership and transaction history is fully transparent. While NFTs have stirred hype, they also represent a powerful new way to prove ownership and transfer value digitally. Let's talk about DAOs, or decentralized autonomous organizations. A DAO is a community-led organization governed by smart contracts and token holders, with no central authority. Instead of a CEO or board, decisions in a DAO are made via on-chain votes. Members propose changes or strategies, and those who hold governance tokens vote. This is crypto's answer to corporate governance: open, transparent, and theoretically more democratic. Examples include MakerDAO, Aragon, and ApeCoin DAO, each using tokens to coordinate communities. Another major concept is stablecoins. These are cryptocurrencies designed to maintain a stable value, typically pegged to fiat currencies like the US dollar or euro. Stablecoins like USDT, Tether, USDC, Circle, and DAI, MakerDAO, are used across DeFi, trading, and payments. They offer the best of both worlds, blockchain efficiency and fiat price stability. There are three main types: fiat-backed, collateral in bank reserves, crypto-backed, like DAI, and algorithmic, which rely on code to manage supply. Each comes with trade-offs in stability, transparency, and decentralization. You'll also hear about airdrops, a popular crypto marketing strategy. An airdrop involves distributing free tokens to wallet holders, either as a reward for early usage, to incentivize adoption, or to decentralize governance. Airdrops have become a way for crypto users to earn unexpected rewards just for holding or interacting with a protocol. For example, early Uniswap or Arbitrum users received significant token allocations via airdrops. These events can generate hype, build community, and serve as a user acquisition tool for projects. Let's move into the world of oracles, a critical component of blockchain infrastructure. Oracles are third-party services that provide external data to smart contracts. Since blockchains are closed systems, they can't access real-world information on their own. Oracles solve this problem by feeding data like asset prices, weather reports, or sports scores into the chain. Chainlink is the most well-known decentralized Oracle network. Oracles are essential for powering DeFi apps, prediction markets, and any smart contract that relies on off-chain data. Another term that often confuses beginners is hash rate. In proof-of-work systems like Bitcoin, the hash rate measures the total computing power used to mine and process transactions. A higher hash rate means more security, since it's harder for bad actors to take control of the network. It also reflects miner confidence. If the hash rate rises, it typically means more machines are joining the network, and miners believe it's worth the cost. A declining hash rate can suggest declining profitability or interest in a blockchain. Let's also cover halving, which refers to a programmed event in many blockchains, especially Bitcoin, where the block reward is cut in half. This occurs approximately every 4 years on the Bitcoin network and reduces the rate at which new BTC is created. Halvings are a key part of Bitcoin's monetary policy and are often associated with bullish price movements. The idea is to simulate digital scarcity, with fewer coins released over time, ultimately leading to a capped supply of 21 million BTC. Let's now look at private keys and public keys, two terms that are foundational to how crypto works. When you create a crypto wallet, you receive a pair of cryptographic keys. The public key is like your email address, it's what others use to send you crypto. The private key is like your password, it gives you control over your funds. Whoever holds the private key controls the wallet. That's why you'll often hear the phrase "not your keys, not your coins." If someone else holds your keys, like a centralized exchange, you don't fully control your crypto. Next, we have the idea of nodes, which are individual computers that participate in a blockchain network. Nodes store a full or partial copy of the blockchain and help validate new transactions. Full nodes enforce the rules of the blockchain, ensuring that every block and transaction is correct. Validator nodes, in proof-of-stake systems, also propose and attest the new blocks. Nodes are the backbone of blockchain decentralization. The more nodes, the more resilient and censorship-resistant the network. You might also hear the term fork, which in crypto has a specific meaning. A fork occurs when a blockchain splits into two paths. This can happen for several reasons, like upgrading the protocol, a soft fork, or community disagreement, a hard fork. For example, Bitcoin Cash was created from a hard fork of Bitcoin. Ethereum Classic split from Ethereum after the infamous DAO hack. Forks allow blockchains to evolve, but they can also cause confusion, dilute communities, or create competing versions of the same chain. Let's explore TVL, or total value locked, a common metric used to gauge the health and scale of DeFi protocols. TVL represents the total amount of cryptocurrency deposited in a DeFi platform's smart contracts. It reflects how much users trust and use the protocol. For example, if a lending protocol has a TVL of $1 billion, that means $1 billion worth of assets are being lent, borrowed, or staked on the platform. A rising TVL often signals growing adoption, while a falling TVL may indicate user outflows or reduced confidence. Another widely used concept is bridges, tools that allow assets to move between different blockchains. Since most blockchains are isolated systems, bridges are essential for interoperability. For instance, if you want to move USDC from Ethereum to Avalanche, a bridge helps you transfer it across chains. However, bridges also come with risks. Several high-profile hacks have targeted them due to their complexity and centralized elements. Despite the risks, bridges remain vital to the multi-chain future of crypto. Let's now talk about Layer 1 and Layer 2, two of the most important structural terms in blockchain architecture. A Layer 1 blockchain is the base layer of a network. Examples include Bitcoin, Ethereum, and Solana. They handle everything on-chain, including security, consensus, and data storage. A Layer 2 solution is built on top of a Layer 1 to increase speed and reduce costs. Layer 2s like Optimism, Arbitrum, and Polygon scale Ethereum by handling transactions off-chain and settling them on-chain later. This setup allows for faster, cheaper activity without sacrificing decentralization. Let's dive into DEX, or Decentralized Exchange, a platform that allows users to trade cryptocurrencies without a central authority or intermediary. Unlike centralized exchanges like Binance or Coinbase, DEXs use smart contracts and liquidity pools to match buyers and sellers. Popular examples include Uniswap, PancakeSwap, and SushiSwap. DEXs are non-custodial, meaning you always control your funds, and trades are executed directly from your wallet. This removes the need for KYC and reduces the risk of platform hacks, although it does require a bit more technical confidence from users. Another essential crypto term is governance token. These tokens give holders the ability to vote on decisions about a protocol's future, such as upgrades, funding decisions, or fee structures. For example, UNI holders vote on Uniswap proposals, and Aave holders shape Aave's roadmap. Governance tokens are the backbone of DAOs, representing voting power in decentralized communities. While they're often tradable, their main value lies in influence rather than utility. Let's talk about slippage, which is a trading term you'll encounter often on DEXs. Slippage refers to the difference between the expected price of a trade and the actual price at execution. This usually happens when the market is volatile or when there isn't enough liquidity. For example, if you try to buy a large amount of a token with low liquidity, your purchase may slip the price upward. Most DEXs allow you to set a slippage tolerance, which prevents transactions from going through if the price moves too far from your target. Let's now demystify market cap, short for market capitalization, one of the most referenced metrics in crypto investing. It's calculated by multiplying the current price of a cryptocurrency by its circulating supply. For example, if a coin is worth $2 and there are 1 billion tokens in circulation, the market cap is $2 billion. Market cap helps investors compare the relative size of different crypto assets, but it doesn't tell the whole story. A project with a high market cap might have low liquidity or weak fundamentals, so it should be considered alongside other metrics. Another key term is yield farming, a DeFi strategy used to earn rewards on idle crypto assets. By lending, staking, or providing liquidity, users can farm new tokens or interest. Yield farmers often move funds between protocols to chase the highest returns. However, yield farming is complex and comes with risks like impermanent loss, smart contract bugs, and volatility. While some early adopters earned outsized rewards, yields tend to shrink as competition and liquidity increase. Let's also explain impermanent loss, a unique risk to liquidity providers on DEXs. It happens when the price of the tokens in your liquidity pool diverge in value compared to just holding them. This causes your share of the pool to rebalance in a way that can leave you with fewer tokens of the more valuable asset. The loss is called impermanent because it may reverse if prices return to their original ratio. However, in volatile markets, the loss can become permanent, especially if you withdraw during price divergence. Let's now look at rug pulls, one of the most dangerous and unfortunately common scams in the crypto space. A rug pull happens when a project's developers suddenly withdraw all the liquidity or funds, leaving investors with worthless tokens. This is especially prevalent in meme coins or unaudited DeFi projects where the team has control over liquidity pools. Rug pulls can be technically sophisticated or brutally simple, and they're a reminder of why due diligence is so important. Always research the project, verify contract audits, and check if the team is reputable before investing. We'll end with the concept of on-chain versus off-chain. On-chain refers to any transaction or activity recorded directly on a blockchain. This includes token transfers, contract executions, and voting. Off-chain refers to actions that happen outside the blockchain, such as centralized trades, traditional legal agreements, or Layer 2 transactions before final settlement. On-chain activity is transparent and permanent, but often slower and more expensive. Off-chain methods are faster and more private, but rely on trust or later verification. Understanding this distinction is critical when evaluating platforms or planning strategies. By understanding these core crypto terms, from smart contracts and DeFi to oracles, staking, DAOs, and bridges, you build the foundation to confidently navigate the crypto ecosystem. Each term is a stepping stone toward deeper understanding and smarter decision-making in one of the most fast-moving and innovative financial sectors in the world. Subscribe to CryptoPulse for deep dives, tutorials, and objective insights into crypto's biggest trends.